Okay, it is 8:01. So we'll start the meeting, the webinar. Uh, Good evening, everyone. Thanks for spending your Tuesday evening with us. So try to make it 35 minutes so you can get back to whatever your life calls for. Um, this is day 3 of the webinar. It is the investor webinar series of day 3. We did day 1 and 2 last Thursday and Saturday morning. The day 3 we'll talk about how to find and fund your investment property and what all the financing options you have. Before we start, just a quick introduction. My name is Johnbosco with the LPT Realty. I'm with the Johnbosco team. We are here with our sponsor, After Real Estate, which is a real estate investment wing I'm part of. Um uh, I think that should be enough for today because day 1 and day 2 we talked about in detail what we do. Um, just to give an overall idea what each day. First day we did why you want to invest in real estate and what all the advantages you have and what is your strategy, what strategy is available uh, to invest in real estate. Each strategy has its own. Some of them are short term, high risk, high profit potential. Then the regular long term rental or short term rental that are low risk but lower income potential than flips or BRRRR. Okay. Second day we did we looked at certain formulas, how to use them in the calculation, basic formulas, so you don't have to go overboard like active investors, because most of you are going to be passive investor, meaning you have another job, 9 to 5 job that you are working on, and you are doing this on the during your downtime or free time. Then talking about important thing is your buy box. What it is it's your criteria, what you are going to be using. It fits your strategy, your investment goal, and the criteria. So you are not looking everywhere trying to find and wasting your time. You are focused on within whatever within the criteria. Get it, keep it simple, get it, and repeat it again. Okay. Today we are going to see we have our buy box built, the criteria where we want to look and what kind of investment property we are going to be looking at and which neighborhood, because I'm saying neighborhood, it's not going to be metro level, city level, it's going to be neighborhood. So you know about the neighborhood, you have done research about the neighborhood before you are buying a property in the neighborhood. Okay. Um, then how do you fund it? There are different ways to fund investment. If you have all cash, that's great, but most are going to be using some kind of um, a mortgage or loan or private loan, whatever, right? So, or it is going to be a joint venture or something like that. Day after tomorrow, Thursday, will be our last day 4. Uh, in that, we'll talk about how to get a property rent ready. We are going to focus on specifically rent for long term and short term. And how do you execute specifically long term? That's what we are going to be talking about, the execution, because short term execution is completely different than a long term rental execution. So then we'll wrap it up. So moving on for today, what are you going to leave after this 35 minutes webinar session? Basically, you are going to see how you are going to find, and we are going to be, because we are real estate agents, realtors. So we are going to be focusing on how you can use a realtor to find your properties. Okay, there are off market. Probably you don't have access to off market property listings, because either you have to generate them or you don't, you have to depend on somebody to give them to you, because you are doing passive in your free time. And if you have the time, that's great, but most of you are not going to have that. Second thing you are going to learn from this is how you have a portal. I call them portal, and because that's where you are going to see whatever property fits your criteria, the buy box you built, and that portal is showing whatever is matching. Then that we call them as leads. Your leads are the property that fit your buy box criteria. Then we'll find out if the numbers work good, and how do we make offers, because it's not, offers are not just price. Offers are not, there are other terms you can uh, adjust, because like we talked about, how do you adjust the knob to make a rental property more profitable, right? Same way, how do you adjust the terms so it is advantageous for you? First of all, in a multi-offer situation, you are getting the offer, or even if not a multi-offer, the seller accepts your offer, because at the end of the day, everybody in the transaction have to win. Otherwise, the transaction doesn't close. Okay. Um, then you are going to choose your funding path, specifically focused on passive investor, active investor. There are different funding paths, more than that is available, that a passive investor can tap in, because some of them have higher risk, higher interest, whatever, right? So we are going to be talking about, as a passive investor, what all your funding paths are. Moving on to the sourcing channel, like I said, the portal, you are going to build your portal, and that's where all your uh, candidate properties, right, that fits your buy box, they are going to show up. You can use my website. Our team's website is johnboscoteam.com, one word. You can register and set up your search criteria using whatever you define in your buy box. Same thing you can do in Zillow or Redfin, whichever you are comfortable with, but use only one, because everybody else, every single website, whether individual or Zillow or Redfin or Realtor.com, everybody gets data feed from MLS. Okay. When they get it is what differs. As an investor, you probably shouldn't care about, you need to know right away. Right, you are going to be looking at it during your free time. Most of the listings gets listed in MLS during the morning time. So if something gets listed, and whether it's Zillow, Redfin, or some of the other websites, there is going to be a lag, because they need to get the data, and they are not getting the data live. Some agents, like our website is directly attached to our MLS. Anything that is in Bright MLS, which covers part of most of the South New Jersey, eastern part of Pennsylvania, Delaware, Maryland, and Virginia, and some part of North Carolina. So that anything listed in that one is going to show up in my website immediately. Okay, so if you are looking at anywhere else, probably you need to look some other local realtor's website that directly attached to the MLS, or you can look at it, use Zillow or Redfin or Realtor.com. So once you set it up, probably there is going to be some fine tuning, and you are going to say, this is what I did. If you are going to work with a realtor, like if you are going to work with us, this is what normally we do. We set up, replicate exactly your buy box into our MLS alerts. So that way we get we also get notified and work with you and call you and say, did you see it, or send you a text message if you are at work. We know you are going to be at work. We send a text message saying, take a look at it. This just showed up. Maybe you may want to look at it, something like that, right? So that way it gives you a quick heads up and everything, and you can act upon what your next steps are to analyze, or whether you want to make an offer, whatever, right? Normally I prefer, I suggest every initial beginning investor or passive investor who has one or two properties looking for a next one, don't go and look for it every single day. You're not going to find. If something is going to be a good deal, that's going to go away, which you may not be able to get it immediately, that's okay. Look at it, uh, look at 2-3 days a week. That's all you spend on. Then do your math. Your math is going to be taking longer because you take the property, do the analysis, run the numbers. So even if you don't like it, always run the numbers so you get used to how to do it faster, right? That way you are as the months or days goes forward, you are able to do it quicker, and probably sometimes mental math at some point. Okay. Then call the agent. If you find something in Zillow and you are not working with the agent, call the listing agent, find the information. But I normally recommend any buyer to have a realtor represent you, because you call a listing agent, they are representing seller, and they have to, by law, by nor required by realtor association requirement, they have to work in the interest of their client, who is the seller, not you, the buyer. So always have a representation. That way you have somebody to make sure that you are covered from any potential loss or potential risk. Everything is identified, and you have somebody representing you, talking for you, not talking to you. Okay. I have given this, and if you look at the table, column 2 and 3 are our proprietary information. So, but want to give an idea what we normally do. So our offer what we look at mainly is what is the inspection window, and we always require everybody to have an inspection, even if you are going to do a gutter renovation, because at inspection you should be able to find if something is completely broken or not. We need to know, or some other thing that you didn't think about, or you didn't see when you were doing the touring. Okay. Then the appraisal plan, and how are we going to do appraisal? Does it need an appraisal? If it needs an appraisal, when are we going to do? And your EMD is the deposit you put to make the offer concrete, and that is one of the things that seller is going to look for. How much EMD, and so how serious you are, right? You cannot put $100 and say, I am serious, Probably not, because you don't have the skin in the game as far as the seller is concerned. Closing date is another, how fast you can close. If you already have everything lined up, your loan and everything, you can close it within the 30 to 40 days time frame. And if you are a cash buyer, you can close it much sooner. And of course, the seller credits. If you are asking for seller's credits, what type of credits you are asking for, whether the seller agrees or not. Let's take a look at a little bit an example here. Just to give an idea, there's no real numbers. I'm just giving an idea. Let's say we are asking for a $6,000 price cut. At 7% interest, you are saving around $40 a month for a $6,000 price cut, because your mortgage goes down that much. However, is that a good deal? Probably most of you might think it is a good deal because your price is reduced. That is not what you are, because you are getting a mortgage, you have other expenses, and that's one other reason. On day 2, we ran the numbers. You want to see how your numbers are going to be impacted, your net income, your cash flow, your capital cap rate, or your DSCR can change too altogether. Let's take a second point in the example. Same 6,000, we didn't reduce the price. Instead, we asked the seller to give the $6,000 as credit towards closing. So we used the $6,000 with the mortgage lender and buy down the interest rate. Probably for $6,000, let's assume it is 1%, 1.5% of purchase price or the loan. You're probably looking at around 0.2, 0.25 less, which means you are saving in a month between $90 to $120. So now you see the difference. Just reducing the price, you saved only $40, which meaning your cash flow increased by $40 if you would have bought asking price, right? Now, instead of reducing the price, you are reducing your interest rate using seller credit. Same effect for seller, but your effect as a buyer, you are making another $50 to $70 more if you would have reduced the price by 6,000. So that is what we do. Okay, we look at the subject line. We make an offer. We look at all these EMD, price, comps, whether the property has proper equal comps, right? If it is equally priced, market price is correct, what we are making offer, and inspection. Like I said, we always recommend inspection and want all our clients. I want any of you, if you are a passive investor, to do an inspection always. Appraisal, if it is needed, then your deposit, how much deposit you want to put, and then your DSCR that we talked about, the debt ratio, how it is going to change between when you change one knob in the offer, something else changes, because everything has equal impact, right, somewhere else. And whether you want credit or whether you need a price, it's not one. We look at it, what you need, what you should have to get maximum from the investment at the end of the day after you purchase. Okay, then anything else we need, and we do the negotiation based on that. Now moving on to the offers checklist. This is the basic thing that we do. We do other things, and we have broken down each one. We have a detailed checklist that we send. That way, whether the listing agent or the seller don't have to come back and ask for more clarification or anything. They already have everything they need to make a decision. So always we have a cover sheet, and all we have we provide the comps to justify why we are offering. Why our offer is that to make sure to show the offer is market price offer. We are not lowballing. We are not paying. We know what we are doing. That's what it shows. Then proof of fund to show that you have actually the funds to buy the property, whether it is loan approval or pre-approval, or you are all cash offer, you have your cash reserves, right? So everything are for your down payment, your cash reserves. Inspection, I mean, normally require, and we recommend. So you can some of our clients may choose not to do inspection because whatever reason they are going to, they may not need it. Again, appraisal, if you are going to take a loan, there's going to be an appraisal and we'll plan for it, and we'll be there. If we are representing you, we normally be there for the appraisal to make sure the appraiser is doing everything, has enough information what we think they should have. Okay. Then the EMD, then close date, credits, and a file name. We just make sure everybody has a file name. It's our standard. Just to show we have standard everything. We have a process. We have checklists. Okay. Then the financing menu. This is your basically, if you are going to see a brochure for you, this is a menu for you. What are the financing options you have? Your conventional, like your primary house mortgage, that is your conventional. Probably you have that, right? Whether it's FHA loan or whatever. Then your DSCR loans, that usually DSCR loans do not require your income. They are based on the property income. Then your HELOC loan, that if you have a primary residence, you have a home equity line of credit, you can get and use that line of credit money for down payment and any renovation or anything like to prepare the property. You can use that funds. So that is some fund. That is a fund that is available to most homeowners who has a primary residence already. Okay, if you have owned the house for 1 or 2 years, you probably can get a HELOC on the property, assuming you have at least some 80% loan to value. Okay. Then you have option for 80-10-10. You put 10% down and 80% loan, another 10% to match the difference. So you'll have two loan, one for 80%, the main loan, 10% is for the bridge between two, so you don't have to pay PMI, private mortgage insurance. Okay. And then if you have a 401k, now most people don't realize their 401k they can borrow from and you can pay it back. The interest also is not tax free. So if you, let's say you borrow 10,000 from your 401k and you are paying monthly, and the total the interest for 5 years, 10 years, whatever is approved and by the 401k broker. Okay, whoever whatever it is, let's say over the period you paid $2,000 interest, so you paid back to your 401k 12,000. all the 12,000, you already, the 10,000 you never paid tax, the 2,000 you paid, you are paying more into your 401k, which you wouldn't have if you didn't take a loan. Now that 2,000 is going to grow also. Okay. So that is something that always you can tap into. You can talk to your 401k administrator and they can help you with how much you can borrow against your 401k loan. Okay. And then you do cash out refinance. You can refinance your existing properties and take cash out and use that cash to buy next one. The SB lock is specific. What it is security backed line of credit. Is for short-term liquidity. What if you have a stock brokerage account and you have enough stock, and you can use your secure stocks as a security and get a line of credit. That depends on your credibility and what the bank has criteria. You can. That is an option too. So you don't have to sell your stocks, but you are taking loan using the stocks as a security. Okay. Here is a quick math. We already looked at this on day 2 Saturday. DSCR is basically net operating income divided by your annual principal and interest payment. It is annualized, not monthly. Okay. And what is NOI? It is your effective gross income minus OPEX. At the end of the day, if you look last year's performance, it will be actual gross income. But when you are calculating for an investment, it is effective gross income because it doesn't take consideration of vacancies and the tenant not paying. So that's why we call it effective gross income, not gross income before you buy the property. Okay, and minus OPEX is again your estimated OPEX. Then monthly P&I, I just put the actual formula, and there you don't have to. There are a lot of online calculators, mortgage calculators. Just put in the numbers, and it will tell you how much your monthly P&I is going to be. Okay. Now let's take a small example. This is the same duplex that we talked about on day 2. We are using same example. If you want, you can go back and look at the recording. We should be posting the recording sometime early next week. So all the 4 days will be posted in and available. You can either view it in our Facebook Facebook page or our YouTube channel. Okay. If you don't know where it is, you can go to our website, johnbosco.com. At the bottom, you should see link to all our social media platforms. Okay. Let's take the example. Here is what we did. The purchase price is $300K. Okay. The rent is $1,000 for unit 1, and for unit 2, $950. Insurance and taxes are $425 a month. Maybe take the yearly and divide, because we are now looking for how much our monthly expense is going to be. Okay, and we are assuming the vacancy rate per year is 5%. Property management fees are 10%. We are assuming here you are not managing the property. You have a property management, and average it's best to use 10% because you may be able to find somebody at 8%. But when you do the calculation to determine, always use the worst case scenario. Then you are assuming we are assuming here yearly we are going to be spending around $1,200. So we are assuming it's going to be $100 a month. for repairs and maintenance. Not maintenance specifically, repairs. Okay. So let's say we are taking a conventional loan, 7% interest. It's a 30-year amortization loan. You are going to be required anyway 25% down minimum. Sometimes some places require 30% depending on your experience and the relationship with the bank. The loan is 225K. At that, the P&I is 1,198 per month. The DSCR comes to 1.25 because it's net operating income, which is around 18,000 because we have 1950 multiplied by 12. Then cash on cash, it's cash in is 85K we put in. That is your 25% plus, let's assume 6K for closing, and you did a 4K worth of preparation, repairs, whatever, right? You are just painting and cleaning the house cost you 4K, whatever. To get the house ready for rent, you spend 4K. So everything is what you put in. That's your cash you put in. Annual cash flow in this case is NOI minus debt, which is 18,000 minus 14,000 at 376. The annual cash flow is 3,625, which is basically cash on cash. How we came up with 3,625 divided by 85,000. So your 85,000 has the annual return of 4.3%. Is it a good deal? I don't know. It depends on what your buy box is, what you wanted, what your goal. For me, 7% is what if. Otherwise, I would have put the 85K into S&P 500 ETF, and that average gives me 7 to 8% over the years. So why would I do all this to get just 4.3? So you have to set your expectation, but it's not just that. You are going to be looking at other things too, your appreciation and tax and everything that we talked about day one. So it is your goal, right? So, but cash on cash in this case is going to be 4.3%. Now, looking at the DSCR, it is going to be 7.5%. And let's say we have a DSCR loan, okay? DSCR is going to be a little bit higher interest rate than conventional because they are not looking at your income. They are looking at the property as an income generator. Let's assume it is going to be 7.5, 30-year amortized, 25% down. The P&I comes around 1234 per month, which is annual. You are looking at DSCR 1.22. Comparing to conventional, we had 1.25, the same NOI, right? But look at the cash on cash. With that, it goes down because we have a little bit more we paid. But what this gives you is this is not looking at your personal income, personal expenses. They are not looking. So if for somebody who cannot use conventional, this is another option. Still, you are making similar cash on cash and others, and that it's going to appreciate same. Everything, the expense in gross income, everything is going to be same. Only thing it is going to be varying is lesser cash flow. Okay, and the main reason I put DSCR 1.22 to make sure to show you that that is important, even because if you are going to get a mortgage, they are going to be looking at it. They would like anything over 1.2 and above. Okay. Let's say we are taking a conventional plus HELOC to do part of the down and part of the repairs. You have a primary residence, you are using that HELOC to as a down payment and repair. Okay. So let's say you HELOC normally when you take the money out, you have to have pay minimum every month. That's usually the interest or a little bit more. So it is not going to be too much, okay, until you pay off the HELOC. So we are here assuming the HELOC is going to cost you $100 a month, which is $1,200 a year. The DSCR on the first one hasn't changed. It's going to be the same conventional loan, but you have taken the HELOC because you don't have enough money saved for the down payment. You are tapping into your primary residence equity, okay, for down payment and other expenses. So in this case, the DSCR hasn't changed. It's still going to be 1.25, which is good for the lender, right? They have the first lien on the property. It's still 1.25, and your cash on cash, however, will reduce a little bit than the conventional one because you are now $1,200 for the year less. Because we had before $3,624 as cash net annual cash flow. Now you pay $1,200 for HELOC payment, so it came down to $2,424. The cash on cash went down 0.3, which is still good, but comparable, 4.3 versus 4.4. So this is how you have to decide how you can get in, because if you are just looking at conventional, you probably would have thought you couldn't have bought by this property, but looking at the DSCR and conventional plus HELOC, now you have more options. You can buy the property, right? Your options, the funding options are more than what you thought originally, because you thought you have to have saved 25% for down payment, so you have to now you are waiting to save that. Instead, if you are looking at conventional plus HELOC, you can actually tap into your existing home equity and get in the game before way early, which means you are building your property is building appreciation. You still have your cash flow. Okay, cash flow is still 2,400. It's not per year. That's $200 a month. That's something you didn't have before. Okay. And also you have year-end tax savings that year. So think in terms of how your investments work, not what you are paying, whether you need to put down payment, whether you need to reduce the interest. That's not what you are going to be focused on when you do investment. Okay, because you are trying to make everything work. Sorry. Okay. Now, how do we prepare? What do we need for financing? Your lender, what they need, your idea, of course, your income assets, your REO schedule. With what it means is your real estate want, what all the real estates you want. They're going to have you ask you. If you have just the primary residence, that's the primary residence. But if you have few other real estate rental properties, real estate investment, they are going to see that, because that one helps for helps the lender to decide how much risk they have or how much risk they can reduce, because the more real estate you have, probably you have equity in each one of them, and they are going to be considering that part of the risk, right? Their risk is much reduced than if you didn't have that equity, that didn't show the equity. So those are the real all the property information, current value, current mortgage pay amount, payoff amount, everything you are going to compile and keep it ready. Then the subject property you are going to buy, and what are the rent rolls if it is already a rental, right? If it is not a rental at all, you are going to create pro forma, find the market ongoing rent rate and other information and comps, and going to provide that to the lender. Because the more information you provide on this, the lender it's easier for the lender to make a decision. Otherwise, they are going to be looking for it, and it is going to prolong the process. And sometimes if they don't have enough information, they are going to deny the loan. So then, of course, your insurance binder that they would need for the property. If you are going to have an investment property, you are going to have a landlord insurance. If you are going to be flipping, you are going to get a builder's insurance for whatever the period you are going to build, and because after that you don't need. So you are going to have a builder insurance at that point. For long-term and short-term rental, you are going to short-term rental, it is going to be a little different, but you saw both is going to be landlord, not a homeowner's insurance. So they are different and covers different things. Long-term, you are not covering the tenants' properties. Tenants' personal properties is covered by renter's insurance, not your insurance. So landlord insurance does not cover that, so your insurance is a little bit less as opposed to a homeowner's insurance. Okay. Also, it covers certain things that uh, the insurance company looks for or you need as a landlord. Talk to your insurance agent and get the right insurance if you are going to be having a rental property. Then, of course, the appraisal, and if you already have the DSCR calculated, provide that too, because that shows the lender that you did your due diligence. Okay, gives them a little bit confidence. Then it comes to negotiation. You basically you are negotiating for everything, whether you are buying the property from the seller or you are getting a mortgage loan. You are negotiating at that point. So how we negotiate, what are the things we need to negotiate. I talked about, again, to reiterate, price reducing the price is not just the only thing you can do. Okay, there are other things you can do, and a knowledgeable agent can help you with all those. It's not just interest rates, not just getting seller credit. There are other things we can do. Negotiate to get you the best deal for future. Not when you buy, you are not going to be seeing the difference, but over the years, every month, your cash flow is higher. Yeah, your repair expense is lower. So those things we can adjust to make it work. So all the knobs we talked about to make the property more profitable can be negotiated into when you purchase the property. Sorry, give me a second. Okay. Yeah, already 8:45. So how do we help? We put the deal desk, offer packaging, and we match you with the lender. If you don't have a lender, we give you recommendations, and We have transactions checklists that we do internally, and also we give you for you as an investor what are the things you got to get prepared before purchasing the property, and after purchasing the property, we help you with basic checklists and things that you need to execute. Okay. That is for today. I think you have gained some knowledge. If you are already thinking about it, probably you have more options you can think of. Um, like using your HELOC, and it's not just the price, not just the interest rate. Don't get tied up with it's the end game. End numbers is the one you have to look at it. It doesn't matter unless you are putting the 100% cash in. You can then a price difference may make a difference, right? That's savings for you, but you as an investor, you don't want to put 100%. You have to leverage efficiently. If you have enough money to put 100% down, instead buying one, you can buy probably two or three easily, right? Get them a loan, and so you have to think differently than a common man, normal home buyer. When it comes to real estate investment, it's not when you, especially when you buy. So use the right agent. Like I said, a knowledgeable agent can help you, and always use somebody, an agent or somebody to represent you. Do not represent yourself because you are not that's not your expertise. Your expertise is whatever you do in your 9 to 5 job or day job, right? There are a lot of legal nuances that you got to make sure it is addressed. So that said, thank you. And if you have any question, you can put it in the chat. I don't. I'll wait for 5 minutes if I don't see any chat, anybody. Uh, Give me a second. I don't see any questions, but if you have specific question, here is our my contact info. Send me an email or text. That should um, that will I should be able to get back to you within a day. If you want to set up a time for 10-15 minutes, we can share that setup and talk over the phone if needed. If you have specific one that you want to run it by. Or if you have an existing property, you want to see what you can do, something like that. I can help. I would be glad to answer that.